Hi, today is Friday, November 14th, the day after the big shorts. Michael Burry throws in the towel and walks away. He was probably the biggest bear or the most popular one out there, but he is not the last one. So naturally comes to my mind the question of, is this the moment markets finally crack or the point where bulls charge even harder? So welcome to Swissquote's Daily Market Talk. I am İpek Özkardeskaya and all I say here is based on my personal views and opinions, and this is not financial advice. I see no need whatsoever for a long introduction here, so I'll dive directly in there. Michael Burry is done with this. In a short letter yesterday, he announced that he is liquidating his funds and returning capital. Why? Because his estimation of value in securities is not now and has never been for some time in sync with the markets. In short, he's been thinking that the market is overvalued for quite a time now. He's been short the booming companies like Nvidia and Palantir, for example, and for a good reason, but he's apparently growing increasingly desperate about the time the market will go back to its senses. Senses being valuations that point at P, PS or P whatever ratios that make sense to him and to many. The S&P 500 companies, for example, trade at an average PE ratio of 23 today, well above the historical average of 18. So there's nothing we didn't know here, but wow, that feels like the biggest bear has just fallen, just given in to the aggressive AI bulls and their insatiable appetite for technology stocks or anything that would rally fast and high enough to keep the show going. Now, funny enough, Nasdaq wasn't up yesterday. On the contrary, it was down by 2%, with Nvidia dropping more than 3.5% in just a single session. I don't want to say this, but I hope that the big bubble burst doesn't start the day after Michael Burry buries his positions. I mean, that would be quite ungrateful to him, really. But zooming out, short positions against S&P 500 increases along with its price, with or without Burry. Institutional traders are clearly breathing on the neck of the retail bulls right now, and for some time, because the CFTC data actually suggests that leveraged net positions were rather negative since summer 2022. So the game here is pretty much clear. If retail traders, that we also call pajama traders, could hold on to their long positions long enough to push the bears away, well, the bears will get washed out and the rally in the technology stocks and other pockets of the market, especially the riskier pockets, could continue. That's probably what Burry thought when he made his decisions to just get the hell out of here. Maybe market will really crash one day and there will be the big short too. Who knows, but he's not going to be the big star who would have won billions out of it. But anyway, what likely triggered yesterday's sell-off in the markets was the growing realization among investors that a full set of jobs and inflation data from the US won't land before the Federal Reserve's December meeting. And if that's the case, and if the Fed retains even a minimum degree of independence and reason within itself, it wouldn't cut its rates blindly this December. Atlanta Fed President Raphael Bostic, for example, said on Wednesday this week that price stability remains the more pressing risk as signals from the labor market don't indicate a cyclical downturn clearly enough to merit significant policy loosening, while inflation remains well above target. Well, happily, he will retire next February. But then, other Fed members out there also echo the same inflation worries, increasing the discomfort level among, Fed dolls and risk investors. So there you go, the US 2-year yield that best captures the Fed expectations rose to 3.60% yesterday as stocks fell. It's a bit softer this morning, but the US futures are still in the negative at the time I'm talking here. And if yields keep pushing higher, the stock sell-off could accelerate. But if that sell-off deepens, the Fed could be more tempted to cut the interest rates come December. So in that sense, I still believe in the system. I still believe that this system remains well anchored to keep propping up asset prices, whatever the fundamentals say. Because no one wants to be that Fed chair that triggered another financial crisis or caused a bubble pop. But right now, optimism around the end of the US government shutdown is clearly giving way to panic and chaotic market moves. The US dollar sell-off this week, for instance, accelerated yesterday, and that despite the hawkish Fed expectations and rebounding yields. You would have expected the exact opposite to happen, but we don't understand what's going on in the markets anymore. No one does. Maybe it was yen, because the dollar yen hit the 155 psychological mark yesterday and retreated from there for the second session in a row. That 155 level now seems to be the new pain threshold, the point that triggers official unease, as Japanese finance minister clearly doesn't feel comfortable with the yen's rapid depreciation of late. But I'm sorry to say this, Mrs. Katamaya, but if the Japanese yen bears persist, well, they will likely win this game. Because spending FX reserves to stop a currency slide while your prime minister is at the same time pushing for a looser monetary policy and going against any interest rate hikes is a losing battle. The only way to reverse that depreciation trend in the yen when pushing against rate hikes would be through very strong growth. And that's not on the menu of this Christmas for Japan. Because Japanese GDP grew just 0.5% last quarter, and that was already better than expected, after 0.1% growth in each of the two preceding ones. So I wouldn't say FX interventions are useless in the short run, because they actually do wipe out bearish positions temporarily and let the currency breathe a little bit. But in the medium run, it's like fighting the waves with your fists. So the dollar yen is far more likely to test the 160 level than fall back below the 150 if left alone. So if we summarized, the US dollar is unloved, the Japanese yen is unappetizing, and I won't even start on sterling. Cable rebounded yesterday, but it rebounded only thanks to the US dollar's sell-off. But seriously, sterling is a no-go before the autumn budget announcement that's going to be on November 26th, and the pair already gave back most of its gains of yesterday before I even had time to call it up. And underneath, Rachel Reeves wishes that she'll have billions of pounds of extra room in her budget at the end of this month, helped by lower inflation and lower interest rates in the UK. But the data tells another story, a completely different story. It tells that we are facing an economy barely growing for the UK, battered by tax rises and inflation. Not helping either, Land Rover's production halt after a cyber attack weighed heavily on the latest industrial numbers from the United Kingdom. And the growth is not doing well either, and it's just depending on few big companies. And it's hard to see how the UK could generate growth under the current circumstances. Anyway, shout out if you see anything promising out there for the UK's economy. So come November 26th, Rachel Reeves will either upset investors or she will upset taxpayers. So either taxpayers will take the hit and the economy will be left to a slow death and the Bank of England will come in and cut the interest rates, or investors get upset, we get another gilt crisis, and the Bank of England still cuts the interest rate. So either way, a 25 basis point cut from the Bank of England this December looks increasingly likely. So downhill seems to be sterling's year-end path. Anyway, it's enough for this week, I guess. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.